Government spending, taxation, and fiscal policy. Welcome to our 11th topic in this course, in which we will discuss government spending, taxation, and fiscal policy. This will be a practical discussion, including explaining how the U.S. federal budget process operates, and considering what fiscal multipliers tell us, what type of government spending has the biggest bang on the economy. This discussion is an introduction to public finance and fiscal policy issues. Please read Chapter 11 in the textbook. This topic will introduce you to the practical side of economic fiscal policy. You will learn about 1. How fiscal policy works. 2. Adam Smith's theory of optimal taxation. 3. The types of taxes that exist. 4. The types of spending, discretionary and mandatory. 5. The distinction between federal deficits and the national debt. 6. More countries are establishing oversight advisory functions to help government policymakers better handle fiscal spending and taxation. 7. The U.S. process of funding the federal government, and some problems in implementation. 8. How automatic stabilizers work in the economy. 9. What a sustainable fiscal policy is. 10. The need, or not, of a balanced budget. 11. Some theories of government finance. 12. How government borrowing affects private saving. 13. A theory of government deficits and inflation. Okay, let's begin. The starting point is to ask, how does fiscal policy work? One of the best succinct definitions that I have seen was put forth by the IMF. The IMF wrote that governments influence the economy by changing the level and types of taxes, the extent and composition of spending, and the degree and form of borrowing. The overarching goal of the government's expenditures and taxes is to promote stable and sustainable economic growth. Collecting taxes has been an important role for governments. But what are the factors that should be taken into account? Or more specifically, what are the principles of optimal taxation? Adam Smith, who is considered the father of economics, opined that everyone in the nation ought to contribute to the support of the government. Smith wrote the revenue-generating mechanism should be based on a tax that has 4 pillars: to be equitable, certain, convenient, and efficient. By equitable, he meant that an equitable tax is broadly crafted to be proportional to one's ability to pay. By certain, he meant that a certain tax is one that is not arbitrary, but clear and plain. It also should have a well-defined time and manner of payment. By convenient, he meant that a tax should have a payment date that is convenient to pay. And, by efficient, Adam Smith meant that an efficient tax is one where the cost of administering the tax collection is as low as possible relative to the amount collected. Smith's first principle of taxation is tied to one's ability to pay. But how are taxes structured to collect revenue and be designed to address one's ability to pay? Taxes can be structured, generally, in one of 3 forms: progressive, proportional, or regressive. By progressive is meant that, similar to the U.S. personal income tax, is one that collects a higher share of revenue from those with higher income through a graduated tax rate system, that is, higher marginal tax rates as income rises. By proportional is meant a tax that collects the same proportion from each taxpayer. By regressive is meant a tax such that lower income taxpayers will pay a higher tax than a higher income taxpayer. They are used as taxes on tobacco, alcohol, gasoline, jewelry, perfume, and travel. So fiscal policymakers must decide on the structure of the tax. The next question is, what economic activities are taxes levied upon? Taxes generally are on earnings, purchases, and ownership. By taxes on earnings is meant individual income taxes, corporate income taxes, payroll taxes, and capital gains taxes. By taxes on purchases is meant sales taxes, gross receipts taxes, value-added taxes, and excise taxes. By taxes on ownership is meant property taxes, tangible personal property taxes, estate and inheritance taxes, and wealth taxes. In the United States, not all of these types of taxes are imposed and, of course, some are imposed by states as opposed to by the federal government. From time to time, there are proposals in Congress for a wealth tax on Americas. What is a wealth tax? Net wealth taxes, based on financial and non-financial assets minus debts, are recurrent taxes, or potentially a one-off tax, on individual, or corporation, net wealth stocks. In 2022, 3 OECD countries levied annual wealth taxes on its residents: Norway, Spain, and Switzerland. There were more countries imposing wealth taxes. However, those countries abandoned the wealth tax for various reasons, not the least of which is the difficulty in assessing the amount of the tax. Although the United States is unlikely to adopt a wealth tax, in 2019, Senator Elizabeth Warren proposed such a tax that was dubbed the ultra-millionaire tax, that would affect the wealth of the richest 0.1% of Americans. The legislation, which would have applied only to households with a net worth of $50 million or more, was estimated by some economists to raise $2.75 trillion in tax revenue over a 10-year period. It was structured such that households with net worth of less than $50 million would see no additional tax. If households' net worth was between $50 million and $1 billion, then there would be a 2% annual tax on that wealth. If household net worth was over $1 billion, then there would be an additional 1% annual billionaire surtax, for a 3% overall tax on that wealth. One of the problems with a wealth tax in Europe was residents could, and did, change their residence to countries not imposing such a wealth tax. To address that concern, the Warren legislation had a 40% exit tax on the net worth above $50 million of any U.S. citizen who renounces their citizenship. Although it would likely be challenged in the courts, law professors from Yale, Columbia, UCLA, the University of Chicago, the American University, Indiana University, Stanford, Harvard, and so forth, in reviewing Warren's proposal concluded that a wealth tax was constitutional. Nonetheless, it is very unlikely that the United States would embrace a wealth tax. What are the pros and cons of a wealth tax? The main reasons wealth taxes have been advocated are to raise revenue, but more importantly, to address inequality. Can the U.S. federal government tax state governments and vice versa? Essentially no, by virtue of Supreme Court decisions, though there is no restriction in the U.S. Constitution. Which branch of the U.S. government determines the federal government's spending? The U.S. Constitution gives the Congress the authority over federal government spending. In Article 1 of the Constitution, it states that no money shall be drawn from the Treasury, but in consequence of appropriations made by law. Has the U.S. federal government ever been forced to shut down due to lack of congressional funding or due to presidential action? Since 1981, there have been 10 government shutdowns, mostly for a few days due to what is known as funding gaps. These shutdowns largely have been for political pressure to yield some outcome by Republicans or Democrats. The full list of those dates is shown in the slide. What is meant by the term federal budget? Congress does not enact a single piece of legislation that is known as the federal budget. The federal budget is 12 separate bills that get consolidated into an Appropriations Act. How does the U.S. federal budget process work? As required by the Budget and Accounting Act of 1921, the federal budget process begins with the President submitting a proposed budget to Congress usually by the first Monday in February. The current process then is that the CBO will submit to Congress a report on the outlook for the budget and the economy in February. By about April 15, both the House and Senate approve a budget resolution, which is its broad blueprint for top-line or aggregate spending targets, to be used to assess individual appropriations and revenue legislation. The respective committees of the House and Senate with jurisdiction over areas of the budget, which are known as the authorizing committees, will begin work to develop a budget for those areas under its jurisdiction. Authorizing committee legislation, if passed by the full Senate or full House, then needs to be reconciled with the counterpart authorizing legislation passed by the other body of Congress. If reconciled, a reconciliation bill will need to be adopted by the full House and Senate. This process occurs for each of the 12 budget bills making up the full federal budget. If passed, then the budget legislation is sent to the President for approval or veto. The passage of the consolidated appropriations is considered the current fiscal year's regular appropriations. What is the role of the Congressional Budget Office in this budget process? The Congressional Budget Office was created by the Congressional Budget and Impoundment Control Act of 1974 to empower the Congress, along with the existing House and Senate Congressional Budget Committees, to more efficiently perform its constitutional charge of funding the federal government. The CBO will provide budget impacts of proposed legislation, and project overall expenditures, receipts, and shortfalls or surpluses between tax receipts and expenditures. The CBO, which is termed an independent fiscal institution, is not alone in its governmental mission to help fiscal policymakers. The OECD tallies about 40 countries with independent fiscal institutions, which have been established to provide independent analysis of fiscal policy and performance, thus promoting fiscal transparency, sound fiscal policy, and sustainable public finances. Among those countries with an independent fiscal institution, include Australia's Commonwealth Parliamentary Budget Office, Canada's Parliamentary Budget Office, Mexico's Centre for Public Finance Studies, and the United Kingdom's Office for Budget Responsibility, to name just a few. Okay, now that we provided an overview of budgeting processes, what are the measures used to judge the effectiveness of federal government expenditures and taxation? This is addressed by the question, what is dynamic scoring? Dynamic scoring, as opposed to static revenue loss or gain, is the estimate of the net cost of a legislative initiative accounting for economic feedback effects. This is how the CBO evaluates a piece of legislation. So, the CBO needs some type of economic model to determine that feedback. A related question is, what is the fiscal multiplier? Ingrained in the dynamic scoring process is the idea that certain expenditures may have a larger, or smaller, feedback effect through the economy. The measurement of the feedback effects is captured by the fiscal multiplier, which measures the change in a nation's economic output, GDP, generated by each dollar of the budgetary cost of a change in fiscal policy. This multiplier has a direct and an indirect effect. The direct effect is the initial, or first round, expenditure. The indirect effect is the circular flow or feedback effect. What types of fiscal spending have the highest fiscal multipliers? In general, the following criteria result in relatively high multipliers. 1. Funding for direct government purchases. 2. Transfers or tax cuts for those likely to spend the money rather than save it. 3. Funding that can be spent quickly. 4. Policies that are credibly temporary. 5. Policies that encourage rather than discourage work and capital investment. And 6. Policies that target structural damage in the economy, such as funding for rebuilding in the aftermath of hurricane or tornado damage to communities. What is the fiscal year of the federal government? A fiscal year is a 12-month accounting period. The fiscal year for the federal government begins on October 1st and ends on September 30th. The fiscal year is designated by the calendar year in which it ends. For example, fiscal year 2022 is the year beginning October 1st, 2021, and ending September 30th, 2022. It has not always been so, but the federal government's fiscal year initially coincided with the calendar year, then was changed to begin on July 1st and run through June 30th, and now beginning on October 1st. The main reason for the change was the same in each case: Congress was slow to enact a budget. What happens if Congress cannot complete its new fiscal year budget authorization legislation before the start of the cycle? When Congress cannot complete passage of its new fiscal year budget authority before the new fiscal year starts, Congress can authorize federal government spending to continue temporarily by passing a continuing resolution, denoted as a CR. A continuing resolution is an appropriation act that provides spending authority to continue the operations of the federal government, based on the prior fiscal year's appropriations acts and levels, which are extended into the new fiscal year. Is Congress generally finishing its budget work on time? No. Since fiscal year 1998 through 2024, the average number of continuing resolutions passed by Congress has been 5, with an average delay before regular appropriations are in place for the current fiscal year of 138 days late. This table on the slide provides the year-by-year performance of the completion of the federal budget process. What are the problems of late enactment of a regular appropriations budget by Congress? At one extreme, if there is no passage of a regular appropriations budget, nor interest in passing a continuing resolution, the federal government would face a shutdown. At the other end of the spectrum, a series of continuing resolutions makes it harder for federal agencies to function and plan their programs and expenditures. What is meant the budget has automatic stabilizers? The term automatic stabilizers means that there will be changes to federal revenues and outlays that will result due to the stage of the business cycle, slowdown or recession. Those mechanisms, which help stabilize the economy automatically, also contribute to short-run fluctuations in the deficit, without any legislated changes in tax or spending policies. Some examples of these automatic stabilizers are outlays for unemployment insurance, Medicaid, and the Supplemental Nutrition Assistance Program, SNAP, which are commonly called food stamps. In fiscal year 2020, for example, those automatic stabilizers added about $350 billion to the federal government deficit in that year. How sensitive is the U.S. federal budget to changes in economic conditions? The CBO periodically updates the impacts of changes in economic conditions that affect the federal budget. This table shows the estimated impacts of changes in productivity growth, labor force growth, interest rates, and inflation on the federal budget. For example, a 100 basis point jump in interest rates would add about $80 billion to the federal deficit. Of course, If the federal government spent only what they collected in taxes, then there would be no interest rate impact on the budget. However, this is not the case. Why do countries borrow? The IMF observed, governments borrow to spend beyond what they can or want to raise through general taxation. There are several economic motives for this. When tax revenues are down, such as during a recession, governments will borrow to pay for existing spending commitments. This is better for the continuity of public services, such as schools and hospitals, and means that the government is not forced to cut spending when the economy is already weak, something that could make the situation worse. This is known as tax smoothing. Governments may go a step further and actually increase spending, or reduce taxes, during a recession to try to boost growth. This fiscal stimulus is financed by issuing sovereign debt. What is meant by the federal budget's on-budget and off-budget receipts and expenditures? Federal receipts and outlays are segmented for budget analysis into on-budget and off-budget, which are those spending and revenues that are walled off from political interference, and those that are not walled off. The off-budget items are those that are segmented or walled off, and include the Social Security Trust Funds, the Old Age and Survivors Insurance Trust Fund and the Disability Insurance Trust Fund, the Postal Service Fund, and a few other agencies, such as the Federal Reserve. However, the so-called unified budget includes both on- and off-budget spending. Take a look at this table, which shows federal expenditures and receipts by on- and off-budget accounts. What is meant by the federal government's discretionary and mandatory expenditures? Discretionary spending is the budget authority, which is provided and controlled by appropriation acts that the current Congress authorizes. Mandatory spending, which also is known as direct spending or entitlement spending, represents expenditures that have been authorized by previous Congresses. This slide shows the shares of spending by type of expenditure: mandatory, discretionary, and net interest. Notice the larger share of mandatory spending, which has been a political issue to find ways to scale back those expenditures. However, if we delve into that spending a bit more, you can see from the table also on this slide that Social Security is the largest spending component, accounting for nearly 36% of the total in fiscal year 2023, followed by Medicare at 22.3%. So the bulk of that spending is due to an aging baby boom population that is retiring. How are discretionary and mandatory expenditures related to on- and off-budget federal government spending? The relationship is shown on this slide. The majority of outlays are on budget, but the majority of the on-budget is mandatory spending. Notice on this table is what is termed the primary deficit. What is the primary deficit? This concept of a primary federal deficit is defined as the total deficit less the net interest outlays. You can calculate that from the entries in the prior slide's table. We will revisit this concept shortly. What is the difference between the federal government deficit and the federal government debt? The federal government deficit, or surplus, is what is incurred each year, while the debt is the accumulated deficits over time. Another way of thinking about this is that the deficit is the flow, and the debt is the stock. What constitutes federal debt? Gross federal debt equals debt held by federal government accounts plus debt held by public. Debt held by government accounts is debt issued for internal government transactions, to trust funds and other federal accounts, and not traded in capital markets. Debt held by the public consists mainly of securities that the Treasury issues to raise cash to fund the operations and pay off the maturing liabilities of the federal government that tax revenues are insufficient to cover. This debt is held by outside investors, including individuals, corporations, state or local governments, Federal Reserve banks, foreign governments, and other entities outside the United States government, less federal financing bank securities. Total U.S. national debt was $33 trillion as of fiscal year 2023. The share held by the public was $26.2 trillion, of which $5.6 trillion was held by the Federal Reserve System. The Federal Reserve held a record high share of the gross federal debt in fiscal year 2022 with its holding of $6.1 trillion. This table shows the gross federal debt along with its share of U.S. GDP. Note that since fiscal year 2013 the gross share of debt to GDP has exceeded 100%. With the Federal Reserve owning so much U.S. federal debt, the next question that is related is, what is meant by debt monetization? The term referred to the Federal Reserve's monetarization, or the purchase, of the federal debt, which holds down interest rates on government debt that would otherwise be purchased by investors. So, the quantitative easings of the Federal Reserve had the effect of lowering long-term interest rates. There has been a long-standing concern, however, that debt monetarization can create inflation. How much of the U.S. federal debt is owned by foreigners? Clearly, U.S. debt is a desirable investment for foreigners. In 2021, about a quarter of total U.S. federal government debt was held by foreigners, which was down from about 34% in 2015. That share has continued to edge lower and was under 24% by the end of 2023. About half of those foreign holdings of U.S. federal debt are by foreign officials, which include foreign governments and central banks, as well as a small number of international organizations, and government investment funds which have accounts at the New York Federal Reserve Bank, including the IMF and the Bank for International Settlement. The chart on this slide shows the growing foreign share of U.S. Treasury ownership through about 2015, and the decline in foreign ownership as a share of total federal government debt. Part of the reason for this is the surge in Federal Reserve ownership, which has put downward pressure on interest rates with less appetite to invest in those securities by foreigners. The table on this slide shows foreign holders of U.S. Treasury securities from 2015 to 2023. Over those years, Japan was the largest holder of U.S. Treasury securities with 17.2% of the total share, followed by China with its average of 16.3%. China's share has varied from 20.5% in 2015 to 10.8% in 2023. These data are from the U.S. Treasury's Treasury International Capital Reporting System, which is known as the TIC data. A long-standing worry in the financial markets has been if foreign holders decide to reduce their U.S. holdings en masse. What will that do to interest rates? Okay, now let's explore the question, why is there a federal government debt ceiling? The U.S. Constitution, Article 1, Section 8, states that Congress has the power to borrow money on the credit of the United States. But to do so, Congress must legally authorize the borrowing through legislation. As a convenience, Congress created an aggregate borrowing authority rather than individually authorizing each expenditure through separate legislation. The Treasury monitors the statutory limit to the debt borrowing authority, and if spending is expected to breach that ceiling, Congress must raise it, to fund spending approved by the Congress. What is the role of the debt ceiling today? The debt ceiling does not authorize new spending commitments, but it simply allows the federal government to borrow to finance existing legal obligations that Congresses and presidents, past and present, have established. However, in recent years this has been a political tool by some members of Congress, to extract spending concessions or expenditure rollbacks from other members. At other times, Congress has waived the ceiling altogether. What are the benefits of a federal government debt limit? According to a Congressional Research Service study, Congress has always placed restrictions on federal debt. Limitations on federal debt have helped Congress assert its constitutional powers of the purse, of taxation, and of the initiation of war. The debt limit provides Congress with the strings to control the federal purse, allowing Congress to assert its constitutional prerogatives to control spending. The debt limit also imposes a form of fiscal accountability that compels Congress and the President to take visible action to allow further federal borrowing when the federal government spends more than it collects in revenues. What are the drawbacks of a federal government debt limit? Again, according to a Congressional Research Service study, the debt limit can hinder the Treasury's ability to manage the federal government's finances. Some budget experts have advocated the elimination of the debt limit, arguing that other controls provided by the modern congressional budget process established in 1974 have superseded the need for a debt limit, and that the limit does little to alter spending and revenue policies that determine the size of the federal deficit. The Obama administration even proposed allowing increases in the debt limit to occur subject to congressional disapproval. Congress can suspend it at will. For example, under the Bipartisan Budget Act of 2018, the statutory debt limit was suspended through March 1, 2019. Then the statutory debt limit was permanently increased effective March 2, 2019, to $21,987,705,611,407.70. Yes, that amount and 70 cents. What proposals are available to leverage the debt ceiling for better discipline in federal budgeting? The Bipartisan Committee for a Responsible Federal Budget has suggested budgeting reforms for Congress that would 1. Link changes in the debt limit to achieve responsible fiscal targets, so that Congress would not need to increase the debt ceiling if fiscal targets are met. 2. Have a debate about the debt limit when Congress is making decisions on spending and revenue levels, not after those decisions have been made. 3. Apply the debt limit to more economically meaningful measures, such as debt held by the public or debt as a share of GDP. 4. Replace the debt limit with limits on future obligations. Why is there concern that the federal government must embrace fiscal discipline? The key concerns that the CBO has raised are 1. Deficits tend to grow over the upcoming 10-year horizon. 2. This also means that federal debt grows. 3. CBO forecasts that rising debt would dampen economic output over time. 4. CBO also argues that this high and rising debt is ultimately unsustainable, and could have severe adverse consequences, and threaten the standard of living for all Americans. 5. Interest on the debt is the fastest growing part of the federal budget. As debt rises, it will crowd out important investments in areas like education, infrastructure, and research that can help grow the economy. 6. Also, rising interest costs associated with that debt would increase the federal government's interest payments to foreign debt holders, and thus reduce the income of U.S. households by increasing amounts. 7. Getting the debt under control will be very beneficial for generations to come, from higher wages to increased investment to lower borrowing costs for families and businesses. Related to the idea that when the government borrows money there may be a clash with private sector credit needs. This leads us to ask, what is meant by crowding out of investment? Crowding out occurs when government borrowing and spending results in higher interest rates, which reduces business investment and household consumption. There may not be a lot of empirical evidence that this has occurred, but it remains a worry among economists and financial market participants. What is the relationship between federal government borrowing and the international trade balance? We mentioned this earlier in the semester. The national income accounting shows that when the federal government budget deficit rises or the budget surplus falls, then the trade deficit must rise, or the trade surplus will fall. The point is that the federal deficit is directly related to the need for foreigners to partially offset that deficit, other things being constant. However, the best perspective on this comes from the CBO's policy growth model estimates that an increase in the federal deficit would likely be financed by three factors, with savings increasing to offset 43% of the incremental federal deficit, investment reduced to offset another 33% of that incremental deficit, and an increase in net foreign investment to offset the remaining 24% of that increase in the federal deficit. What is the impact of increases in federal government debt on interest rates? Different estimation methods and models will produce different responses. However, a study by the CBO estimated that the effect of federal debt on interest rates range from about 2 to 3 basis points for each percentage point increase in the projected debt to GDP ratio. Should the federal government finance its expenditures through taxation, or by borrowing? This question was examined by the classical economist David Ricardo, who opined that increasing taxation or borrowing will have the same effect, that is, they are equivalent. This has been called the Ricardian equivalence theory, although Ricardo later rejected his own theory. Ricardo argued that debt financing, that is government borrowing, is essentially just future taxation. This idea was encompassed in Robert Barrow's 1974 research, but the main criticism of the theory is that it is unrealistic to think that individuals are willing to save today for future tax increases tomorrow, which they may or may not see in their lifetime. What is the lingering value of the Ricardian equivalence? The simple takeaway from the Ricardian equivalence concept is the fundamental insight Ricardo provided so long ago that the choice of government debt versus taxes is one of timing, which still remains valid. Something to keep in mind when considering government finances and tax policy. However, it is often politically easier for governments to incur more debt than to raise taxes. What are some practical problems in implementing counter-cyclical fiscal policy? There are 3 lags when implementing a counter-cyclical fiscal policy. They are: 1. Recognition lag. That is the time it takes for Congress or the President to determine that a recession or some other negative shock to the economy has occurred. 2. Legislative lag. That is the time it takes to craft a fiscal policy to address the problem and to get the legislation passed. 3. Implementation lag. That is the time it takes for federal government spending or a tax policy change to be available to affect the economy. What is meant by fiscal sustainability? Former FRB Chair Ben Bernanke observed, "A straightforward way to define fiscal sustainability is as a situation in which the ratio of federal debt to national income is stable or moving down over the longer term." This goal can be attained by bringing spending, excluding interest payments, roughly in line with revenues, or in other words, by approximately balancing the primary budget. Thus, the primary federal budget deficit or surplus, that is, the federal budget deficit or surplus without the outlays on net interest on the federal debt, is a metric to develop a goal around. This chart shows the primary deficit, which we introduced earlier in this topic. Why is fiscal sustainability important for a nation? According to the IMF, fiscal sustainability should be a goal for nations, because it is a requirement for macroeconomic stability and sustainable and inclusive long-term growth. Finally, we want to touch upon a theory that links fiscal policy to inflation. What is the fiscal theory of the price level? This fiscal theory of the price level is largely due to Stanford University economist John Cochrane, who argues that the price level sometimes is determined by fiscal policy rather than monetary policy. The theory attempts to show that bond-financed fiscal deficits that are not fully backed by future taxes lead to increased federal government debt, which causes the price level to adjust and restore the fiscal equilibrium. Since its inception, this theory has been extremely controversial. With this, we complete this discussion of public finance and practical fiscal policy issues. Take a few minutes to consider these thought questions on this slide.